You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right. Well, last week we had a huddle up, which honestly are some of my favorite episodes. The questions that we get from our listeners of Options Playbook Radio are just very astute, very well thought out, actually. And I really enjoy huddling up with Mark Longo and trying to answer as many of those questions as we possibly can. And because of that, we're going to be starting fresh this week. And to be blunt, I have been traveling. I've been out of the office, taking a little vacation time. And I've been slowly kind of catching up on the marketplace. A lot of times I like to try to unplug. But I think the most interesting news that came out this week in the markets is the supply chain situation, and I wouldn't even say issues, that Target announced. And the fact that they anticipated some supply chain issues and anticipated that a lot of appliances, a lot of just bigger household items were going to be in demand and continue to be in demand going into the summer months. And that just hasn't been the case. Inflation has kicked in. And it turns out that Target now has a lot of things in their warehouses that need to be sold. And they're going to start reducing prices on a lot of bigger ticket items. So because of that, and because I live in the South, in South Carolina, there is a little known company called Ollie's Bargain Outlet. And Ollie's is a real interesting company in that they've always been flush with cash. So whenever firms like Target need to get rid of inventory, they always have cash on hand, and they're always willing to buy it at a lower price and then sell it, obviously, through their stores. They're not the most plush stores in the world. I've been to a few of them, and but their motto is good stuff cheap, and that's partly because they're just buying it cheap. They're only buying things that they can get on sale. So one week you might be buying paint, the next week you might be buying lawn furniture. Whatever they can find at a low price, they buy, mark it down from the big ticket stores, and sell it at that price. So they're a big hit down here in the South, mainly. And it's just an interesting company. So with that long story, I always have to say on Options Playbook Radio, nothing is meant to be a recommendation, but I'm going to address underlying that I'm thinking about trading. We're going to get a little bullish on it. Maybe they end up with some of the target stuff. Maybe they don't. We have no idea what's going on in the background. But I've been using this term a lot, and it's easy to use. It's just a fear of missing out. There's really no place to put capital right now, unless you're trying to target the bottom. If you think this is the bottom, you got capital, then maybe you want to put some more money in the market. As far as the inflationary number, that's going to be coming out tomorrow. And I should actually, with that sentence, let you know that today is Thursday, June 9th. The markets are open. And Ollie's is actually doing pretty well today. I think it's getting a little bit of focus because of the target news. We got the S&P 500 index down around 11. We got Ollie's bargain outlet. Symbol is OLLI. OLLI is the symbol, is actually up $1.12 on the day, trading at 54.50. But like I said, the markets are rocking and rolling, so it's changing every second. So obviously, if you have not heard of this company, you might not even know they trade options on it. But the options marketplace is fairly thin, and it's not always. I usually will look on Options Insider Radio. We look for one of the more active stocks, just because it's really tough to trade options on. But every once in a while, we divert a little bit. So if I'm going to do a trade or a strategy in a marketplace that doesn't have as liquid options, I'm always going to be spreading it. I'm going to be doing something like a long call spread or a short put spread, and I am going to try to work that order. And now, working the order always works well. It doesn't always, but it will work well on trying to get into a trade. So if I'm going to enter a trade on Ollie's, OLLI, I am going to watch that. I'm not just going to put it in and just let it sit. I'm going to try to work the order. I'm going to try to get a fair price for it. And the downside is that if it goes against you, it's very hard to get out of the trade, right? So it's not bad on illiquid stocks, and this is kind of enticing to work an order and see if you can get into that trade at a certain price. But once you get in, when it goes against you, that's where it can really hurt you. And that's part of the reason why a lot of people don't trade illiquid stocks, or just stay away from, or the line that I like to use is you just lay down until the urge goes away. Okay, but we're gonna actually stand up and place this trade today. We got Ollie's right now trading at a fairly high implied volatility. It's just an interesting company, their business model and everything that they do. And considering that we're in areas of high inflation, there's just a lot of things. It's not a Dollar General. It's not a staple where you're just going in to get all of your household supplies at a little bit lower cost overall. They literally just try to find bargains, and whenever they see something on sale, almost like the Warren Buffett of investing. This is always the Warren Buffett of retail stores. They look for deals, buy them, and then discount the prices and sell it cheap. Okay, so, and I only probably know that much because I do live in a area where they thrive, where the Ollie's bargain bargain outlet thrives. So that's why we're looking at this trade today. So here we go. Of kind of a fear of missing out, but if I'm looking at Ollie's, I'm actually thinking about buying it. And we haven't talked about buying any stocks at all in a long time because who wants to be buying stocks, right? The market's way down. We kind of need to figure out that inflation number that's going to come out tomorrow is going to say a lot about the markets. Is inflation going higher? Is it a little bit more stable? I think there's going to be a lot of eyes on it. And obviously we got the employment numbers today. They are, there's a little bit higher unemployment. Now, I think the Fed in general probably wants a little higher unemployment. If they want to try to slow down the economy a little bit, that kind of works for them, but I don't think the government would ever say that out loud. But so there's some interesting news, but once again, the most interesting piece of news while I was out on the road traveling to me is what has happened with Target inventories. Okay. So we're going to go out to July 15th, and we're going to say we're not going to mind buying some of Ollie's Bargain Outlet, OLLI, at a lower price. So it's a $56 stock. Well, right now, what did I say? $54.50. We're going to use that. It's $54.50. So to buy 100 shares of it is $5,450. It's feasible to do, but we're going to target a lower price. And the fact that we have some decent volatility, it doesn't help with the actual bid-ask spreads on the market, but it does say, well, let's sell some premium in here. Let's look at the premium on the 36-day option, the July 15th expiration, with the market at 54.50. The 55 strike call and put are trading right around a mean average around 52.5% implied volatility. So that's some juice. And so we're going to go out and say, if the market were to come down to about the 50 level, I can still sell that 50 strike option contract. And I'm going to give you the bid ask on these options because they are fairly wide. There is no volume in it today. Open interest is 195 contracts. Now, remember, you double that. There's a buyer and a seller on each one of those contracts. So those are the people that are interested in this option contract. And that market's trading at 175 by 215. Okay, a little bit wide, but we're going to work it. So we're going to sell that 50 strike put. And the intention is that if the market did come down to that strike, I would be willing to buy it at 50. I'm going to buy 100 shares at 50, spending $5,000 to buy that 100 shares. Now, that's still a lot of juice that I can bring in. If I can fill it somewhere by the midpoint, I'm getting about $2 on that. And, that's a big if. If I just sold it outright, that would be the scenario. Now, if we're looking to buy the stock, we might just sell this put cash secured. And we haven't talked about a cash secured put in quite some time, once again, because we haven't really talked about buying a lot of stocks outright. We've been using options to try to manage risk over the last, I'd say 5 or 6 months here on Options Playbook Radio. But I'm going to sell that 50 strike, and then I'm going to go down and I'm going to buy the 45. So I'm hoping that the stock that I'm putting some cash to use here, right? And that the stock either stays where it's at or goes up. But I don't mind if the stock came down, and we're looking at about 10% here. Well, for a little less than 10%. And if it does, then we're saying we're willing to buy the stock at that lower price. All right. So if we do that trade, the 45 strike put, our protection is trading 70 by 95. Once again, not a ton of, no volume today, and open interest is low, but I'm going to try to work this spread. And the midpoint for this trade right now is $1. So my buy price on my spread is the strike that I'm selling, the 50 strike put, which is almost 10% below where the underlying stock is at. So I'm saying that I'm going to try to work this order, get in this trade. I'm bringing in $1 on a 5-point wide spread. I like that. If I'm doing 5-point wide spreads, I'd like to try to target somewhere around $1. And if I'm doing a 2.5-point spread, I'm trying to target about half of that, about 50 cents. All right. So the dollar makes me feel good. And I'm 10% below where the market is at right now, saying that I'm willing to buy it if it does go 10% lower. My goal would be that I would have the $5,000 in cash if I got put to stock to be able to buy the stock. But in this scenario, my margin requirement is just going to be the width of the strikes. So the difference between the strikes is 5 points. That means I got to put up for every 1-by-1 spread that I do, $500 in margin. I also have commissions that I got to think about. You always want to add the commissions in. And I'm going to try to sell this at the midpoint of somewhere close to $1. And I'm going to watch it. I'm going to put the order in. I'm going to let it sit there for a while. And if the market moves up against me or whatever, or goes down, I am going to cancel the trade and re-enter it. And I'm going to literally work this order. And if I can't get a fill somewhere close to the midpoint, then after about a half hour of messing around with it, I'm just going to let the trade go. It's that simple. That's the way that I would play this trade. So I don't talk about trading illiquid stocks because honestly, in the top 10 mistakes paper that I wrote that's in the Ally Invest Do It Right website, our community hub, if in there, one of the top 10 mistakes that beginning option traders make is that they trade illiquid stocks. So I'm going against the grain here by looking at this underlying, and I'm trying to give some insights as to if we were to make that quote unquote mistake of trading illiquid stocks, how I would approach it. Okay, so I'm mainly doing this because I'm willing to buy it. Now, if the market goes up, one of the biggest things about a short put spread is it's wonderful if the market goes up. Why? Because you don't have to close the trade. If the market goes up in this scenario and these options expire worthless 36 days from now, you just collect the premium. And you don't have to worry about bid-ask spreads. You don't have to worry about anything. You can put an order in and say, well, I'll buy it back if it's, I'm selling it for $1. If I can buy it back for 15 cents, 10 cents, anywhere between 10 and 20 cents, why not? And you could trade it that way and just leave a good till canceled order in to buy to close it. Or you can watch it. And if it's quite a bit up, you just try to let it expire worthless. So this is how I would trade an illiquid stock. I'm looking at something where I'm selling a short put spread. If I was bearish, I'd sell a short call spread. And I'm going to try to work the order to get in. I'm hoping that I'm correct on my forecast and that if the market does go with me, I don't have to really work the order to get out. I just either close it at a very low price because the marketplace gets there, or I watch it and I let the options expire worthless. Now, goes against me, that's a different scenario, right? So if I have to close this out, if I sell it for $1, I would be interested in closing it out around $2, which is basically double what I paid for it. And I would consider working that order. If you saw it at $2, you want to go on in, place that trade to close it at around $2. And, once again, you're trying to work the trade to try to get out of it, but you don't have the ability to say, well, I'm just going to let it go, right? And play the hope game. If this is the way that you're going to trade it, you're going to have to watch it closely. And that illiquidity hurts a little bit more on the downside than it does when we're initially getting into the trade. So trading illiquid options is a skill, and you need a little bit of luck if the market does go against you. So you got to be prepared that if I sell this for $1, I'm prepared that I may lose my $4 in this situation, which is the width between the strikes. But with that said, I don't mind buying it at 50. And that's really the goal here. If they put it to me at 50, I don't have to worry about bid-ask spreads, right? Stock comes down to 50. Let's say it goes to 47.5. I just let my 45 expire. They put it to me at 50, and I really own it at 49. And now I become a long-term holder in this environment of 100 shares of OLLI stock, or at least a swing trade holder overall. All right. So that was a lot. Here's the trade for the week. So let me just recap it. We're looking at an underlying stock, and it just came on my radar because of what's going on with Target. And we're going to sell a short put spread, wanting the market to stay where it's at or go up. But if the market came down, I don't mind buying 100 shares of the stock at a lower price, 10% below basically where the market is at. But I am nervous because we are in a marketplace like this. So I'm not going to just sell the put outright. I'm going to buy some insurance below that and buy the 45 strike put. So the expiration that we're looking at is the July 15th expiration. That's 36 days. The net credit to the account, if we fill at the midpoint, is right around $1. And that's it for this episode of Options Playbook Radio. If you have any questions you'd like us to discuss in the huddle ups with the Mark Longo, please email them to me directly at theoptionsguy@invest.ally.com. You can follow me on Twitter. My handle is @BrianOverby. And lastly, if you'd like to learn more about the educational events at Ally Invest, please go to ally.com/investeducation. And there you can sign up for email reminders of all of the events we do week in and week out. You'll get one email a week that summarizes what's going on at Ally Invest Education. Thanks for listening, everyone. And may all the options that you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.